Welcome to Global Money Talk, brought to you by SamProTV. Greetings to all our viewers from across the U.S., Korea, and around the world. We're coming to you live from the floor of the New York Stock Exchange in New York City, the financial capital of America. I'm your host, Remy Blair, and joining me here at the New York Stock Exchange this morning is Tai Wong, independent proprietary trader. Good morning, and thank you so much for joining me.
Good morning, Remy. What a day
What a
been,
day,
right?
Absolutely. And right now we are seeing a rally in the U.S. equity markets. The Dow, S&P 500 hitting new record highs. We're also seeing the NASDAQ,
Yes.
Russell 2000 rally as well. So first and foremost, what do you make of that Fed rate announcement?
Well, I want to. If you could pull up graphic one, I just have to pay homage where homage is deserved. So. And this is a picture on the right, Nick Timiraos of the Wall Street Journal. And on the left, and by the way, this is a great movie. It's called Rounders. It's from 1998. John Malkovich plays Teddy KGB, who was a Russian mobster. It's a movie about poker. It's great. But he has a classic line near the end when he says, "Paid that man his money." So Nick, he called it right. I have never seen a single article turn the market as much as his did last Thursday.
Mm-hmm.
I mean, previous to his article, the market was 85.15 in terms of it's going to be a 25 basis point cut. So what really happened there? I think from the results we can piece together what happened. Is I think Jay Powell clearly wanted 50 basis points, and he looked at the market. The market's not looking at 50 basis points, so he didn't want to give 50 and shock the market. The Fed doesn't really want to do that. So they're saying, okay, well, how do I get this into the market? Calls Nick Timiraos. By the way, Nick has written part of the reason why he's such a favorite is he's wrote a book called $1 Trillion Triage that talks about how the Trump administration and the Fed, and particularly the Fed, did a great job in the pandemic because they learned their lessons from the Great Recession that lasted a long time and was very painful.
Sure.
Go hard and go fast. Go big and go fast, I should say. So he became a sort of like, I guess, a favorite of the Fed. So I'm pretty sure this is right. Jay Powell calls him and says, listen, I think there's a real likelihood that we could go 50. Let's see if we can get something out there. Or something, I'm paraphrasing, obviously. Right. So he calls all the ex-Fed people who are not on blackout, and they put this out there, and the winds really, really started to shift. That was still a coin flip. Most economists don't really like to change their views because they're not like proprietary traders or speculators. They don't change their views that quickly, but it was in the market to the fact that I think the whistle number was 50, and it came out, and it was 50, and this is amazing. So. Wall Street Journal, you're going to have to pay Nick whatever he wants.
Well, we did get that supersized rate cut out from the Federal Reserve, the first one in 4 years. But as we move into the rest of this year, as you mentioned, there's a lot on the calendar, right?
Yes.
So not only do we have the election, less than 50 days, but after the election, hopefully it doesn't take too long to know who's going to be in the White House in January, but we never know. But we do get the November rate announcement for the Fed as well as December rate announcement. And you and I were talking ahead of the show, and there are a lot of risk events on the horizon, whether or not we're talking about a potential government shutdown or other risks, whether it's political, geopolitical, or not. So what do you think is the key takeaway as we head into the final months of this year, especially after Powell's statement yesterday?
So the price action was really amazing yesterday. When it came out at 50, everything rallied. Well, except for bonds. Bonds actually retreated a little bit because they got a little, up over their skis. But stocks went up. Gold soared to historic highs. I think just above 25.90. Or maybe it might have even touched 2,600. I can't remember exactly because I was watching so many things. But then the press conference happened. They looked at the dot plot. The dot plot was actually not that dovish, but the market didn't really sense that until until Powell started speaking. But so before we get into the rest of the calendar, which there's a lot of stuff on it, particularly weekly claims today, which was important, let's look at graphic number 2 while we look at the Fed decision. So here are the Fed projections from yesterday, and this contributes to the dot plot, which will be the next slide. And you can see that they see unemployment rising to 4.4% from current 4.2, and staying there through 2025 and then drifting lower a little bit later. The Fed funds rate, the median dot, is only at 4.4, which is basically 4.25, 4.5, rounded higher. That only says it's 100 basis points for the rest of the year. Now, as Jay Powell always says, is at pains to make the point, it's only a snapshot. It can change, but snapshot's good to work with. So if they did 50 and they only have 100 for the rest of the year, that's only 225. And the other thing that I will note is if you look at the longer run dot, it shifted up to 2.9 from 2.8. I don't think a lot of people, except sort of the bond gurus, and our next guest will be a bond guru, really notice that. But that's not inconsequential, that the long-term rate may have to be higher. So let's look at the dot plot. Let's go to graphic number 3. And you can see that where June was and where September was. The one thing I would suggest is that dispersion in 2025 and 2026 is tighter than it was before. So I think the Fed has, the Fed governors and regional Fed presidents have a better sense of what's going to happen. They feel more comfortable, but 100 basis points more in 2025. 2026, 27 is too far out to know. But the other thing I mentioned before, the neutral rate's a little bit higher. So, and then let's go back to Powell's press conference. He said explicitly that do not assume that the pace is going to be 50, 50, 50. And I think the market sort of didn't like that. I think there was a fair amount of profit taking. So you could see during the press conference where I would say he wasn't hawkish, he was relatively neutral, that the S&P 500 was down on the day. Gold had dropped from, I think, 2,600 to 2,560. Bonds were back higher. Dollar yen was rallying strongly. So it was like, wow, is this sell the news? And then overnight, I think the rest of the world said, sell the news, buy everything. The Fed's cutting. So this morning, it's amazing. Everything is higher. I mean, the guy, if you're looking at the list of people who are the stocks that are losing right now, it's probably the short part of the long-short equity plays is my thinking. But let's see how long it lasts. But the market, I think, feels exuberant this morning.
Yeah, absolutely. Tai, you brought up a lot of important points there, especially when it comes to the economic projections as well as what we may expect going forward. So I do have a question for you since you mentioned the rounders. Does Jay Powell have a tell?
Wow. I think he's gotten really good at it. When he started, he would say things, the first couple of press conferences were a little rocky. I don't know if he has a tell, but I'll tell you who I'm going to be watching is whatever Nick Timiraos writes, he's the tell. Right? He really is the tell. He's the man. It was just so amazing. I was just like, he turned the market. I've never seen it before. Yeah,
and I'm sure a lot of viewers who are watching the market action this morning or market reaction on the heels of that supersized rate cut announcement, they're wondering, does this rally have legs? Do you think this will continue?
It's a great question. I always like to say predicting the future is hard.
Yeah, absolutely.
I think it depends on the incoming data. I think the Fed made very clear, Jay Powell made very clear that the Fed's really not worried about inflation at this time. They think it's well under control unless we get some sort of exogenous event, which may even merit a pause. But they know where the neutral rate. Well, they don't know where the neutral rate will be, but they know it's a lot lower than where it is right now. So they're going to. The Fed's saying we're worried about employment. So every employment number, everything that has to do with employment, like JOLTS, which nobody paid attention to until Jay Powell says, I kind of like that statistic. Sort of like ECI back in the Greenspan days. Nobody, it's still on now, but nobody watches it anymore. But he always watched it for productivity or signal productivity. But before I digress too much, it really is employment data, and the market, I think, is trying to decide whether or not good news is bad news. If we get good employment data, does that mean the Fed cuts more slowly, which we don't want? So we're going to actually go down on good data. What's interesting is I saw analysis by HSBC, and they said, how did equity markets respond to Fed rate cuts? And well, it's sort of 50-50, but there's a good strategy there. When the Fed is cutting into a recession, the stock markets usually drop fairly substantially in the ensuing 3 to 6 months to a year. But if the Fed achieves a soft landing and cuts and is not a recession, then it's very, very good for risk assets, especially stocks. So I think the market thinks that the Fed has has stuck the landing, to take a gymnast's term, and they've done really well. And now it's onward, perhaps in a stately manner, to 6,000 in the S&P 500.
Well, I think that's a befitting analogy you mentioned, Tai, and as you also highlighted in terms of economic data releases, we will get several ahead of the next November meeting, which does come after the election. But as you mentioned, jobs, we got weekly jobless claims data this morning, and I think previous to August 5th, we didn't focus as much on that jobless claims number, but it did fall to its lowest in 4 months, so that is significant.
It was a little bit of an eye-opener. 219,000 initial claims, and like you said, we've been getting used to. We had that terrible that print at 252, I think it was, and it's been sort of steady in the 230, 240ish range. 219 is was sort of interesting. Like, whoa, that's an interesting number, and particularly because it's the claims for the week that includes the 12th of the month, which is also the payroll survey week. So, my little unscientific sort of analysis, I found that over the past several years, just using a little recency bias, that when the weekly claims for the survey week is lower than the previous weekly claims for the survey week, there's maybe a 62% correlation on how the payrolls will come out. So, given that this weekly claims number is low, would suggest that we're going to get a better payroll employment number than we did last month. It's not a great correlation, but something I'm watching, and it will certainly make me think that I'll err a little bit on a stronger number in the next week in the next employment report.
And speaking of which, yesterday in the press conference, Powell did highlight the unemployment rate and expectations for that rate. So it's interesting to hear his commentary, especially given that there are concerns about the labor market and a soft landing as well. Yeah,
it's clearly what he's focused on. The job market right now is fine, but he doesn't want to cool anymore, which I think is why he did the 50. And he'll probably say it'll take some time for this to work through the system. Monetary policy works with a long lag, so he wanted a big one to start to signal that they were comfortable. And I think he was trying to signal that he's doing this. This 50 is from a position of strength and not from a position of sort of panic. So I think he achieved what he wanted. Yesterday it was a pretty good job.
And you and I have been talking about one area of the economy, and that is housing, especially on the heels of some housing data earlier this week. And of course, we're keeping an eye on mortgage rates and what happens in the next couple of weeks as well as next couple of months. But what do you make of some of the figures we've been seeing? And of course, for viewers out there who might be curious about how this affects, the Fed rate cut affects the housing market here in the U.S.
I think it will start to loosen it up a little bit. It's not the best time for housing. People like to buy, at least for housing sales, people usually like to buy things in the spring, then they can move in the summer, and then the kids can go to school in the kids can go to school in the fall at their new school. You don't want to switch kids in the middle of a school term. That's really for teenagers particularly, or for younger kids, it's a big kind of dislocation. But in terms of people maybe putting down money for new housing that's to be built, I think you'll get a slow increase. But now that the Fed is signaling that they're in a rate cutting mode, which they knew, but it's always it's good to see it start. I think people might say, I've waited this long, maybe I'll just wait a little bit longer, unless there's one property that I'm really, really enamored with and somebody will grab. So I think that recovery will take some time because rates are expected to fall more.
And of course, I do want to take this opportunity to look at where the major equity averages are, because we are seeing green across the board this morning. The Dow Jones Industrial Average is up 0.9% in New York morning trade and is off earlier highs, but is still up nearly 380 points on the session. Meanwhile, the Nasdaq Composite Index is rallying over 2.5% this morning, up by nearly 450 points. The S&P 500 higher as well, up by nearly 1.6%. 6%, and the Russell 2000 is rallying 1.5% as well. So we know that there are gains across the board for the equity averages. We're also seeing crypto assets higher this morning with Bitcoin and ETH rallying. But tell us what we're seeing in the FX market, especially since we had another central bank across the Atlantic announce their rate announcement this morning.
Right. So the Bank of England decided, it was consensus, decided not to cut. They cut the last time they met, and this time they decided not to cut because they were concerned about inflation, particularly services inflation. And been to the UK, things are actually kind of expensive. Perhaps, especially in the city of London. I don't get, when I go there, I don't get out of the city of London very much, and you realize, and you wonder how sort of, regular people, sort of, manage with this. So they're concerned about inflation. So they're going to wait. I think there's probably some rate cuts coming, but they're certainly not following the Fed, so to speak. And then Japan, the BOJ meets tomorrow. They are not expected to move, but they're likely to hike sometime in the next quarter or so. And if you look at dollar yen has had a 2 yen range, which is pretty big for a currency these days, trading at, it was almost touched 144. It's 142.78 right now. That's up, substantially from the lows below 140 that we saw late last week. So I think the dollar is doing okay. Let's see where the dollar index is. Where's my dollar index here? The dollar index is actually up 0.3%, which is pretty impressive after a rate cut. Part of that, I think, is due to the fact that the fixed income markets yields have backed up, and essentially the curve has steepened more. So you have the 2-year yield flat to a little bit lower because near-term rates are going up. But this suggests that, if we achieve a soft landing, we may have to have higher rates in the future, and we're going to put in a little bit more of a risk premium. So we have, where are we? We are, the 2s, 10s are about 14 basis points with the 10-year yield higher. So I expect that to continue, and I expect maybe the whole curve to move up higher if we get some strong employment reports.
And of course, looking at the other markets right now, I do very quickly want to touch on commodities. So we've been keeping a close eye on oil, but as well as gold. And we saw gold hit new record highs at that 2,600 level. So what do you make of that move that we saw?
So I think gold is in a bull market, and in bull markets you buy the dips. So yesterday at 25.60, I thought it might have a little bit more to go just overnight, but just buy the dips, and we're back up to 25.83. I think that's just a steady march higher because you were bullish gold yesterday, and the price action continues to be healthy. It's not a sell the news. Then there's no reason not to buy it today, and it's helping the rest of the complex as well. Crude is also sharply higher, but I think that's really on the back of all the other markets. And then I think copper trading at around 9,500 on the LME, $9,500 per ton, down from 9,600, is still at highs that we haven't seen in a couple of months. So a rising tide lifts all boats, and this is essentially what it's done. Now it's Thursday, sort of a late morning. Let's see how everything closes, but I think if we can hold gains today and not have a big retracement tomorrow, the market mood is going to be, well, this is great. Maybe not as many cuts as we wanted, but let's see how the data come in, and we're finally on the right path. We wanted them to cut. We thought they were behind the curve, and they finally gave us what we wanted.
Well, we have a lot to keep our eyes on as we head into Friday's session as well as the weekend, especially with that quadruple witching event, S&P rebalancing as well. So a lot to keep our eyes on tomorrow, and we'll be covering that tomorrow.
Yes.
But of course, before we move away from what's happening in the market, there are some headlines we're keeping our eyes on. And as we continue to monitor what's happening in the labor market, there's a lot going on for American workers, isn't there?
Yeah, so the Boeing strike, or I suppose the surprise Boeing strike after the union leadership approved it, but then it got overwhelmingly rejected by the rank and file, has led to Boeing saying we're going to furlough white collar employees, as many 50, 60,000 of them, 1 week a month. So as a practical matter, a 25% pay cut, and the C-suite is doing the same things just to say we're doing it just like you. I mean, obviously, it's orders of magnitude different. But nevertheless, they're saying, a strike like this really affects the entire company. So I haven't heard any news from, there's a federal mediator involved, what the next offer is going to be, how long this strike is going to last. But there are a couple of impacts here. One is it's probably going to make companies want to produce more things or have more employees in right-to-work states, like South Carolina, which is building some of Boeing's planes, because they won't have to deal with 4 years and a 40% pay hike, which is what the union wanted. And the other thing is it's also emboldening the labor movement. We saw that Stellantis unions were thinking about striking. Sean Fain's been very combative as the head of that big union, and I don't think they'll actually strike because the issues really are not quite in their favor. But there's murmurings about it that we want more because that other guy got more. So then the other thing, another union headline, though not really directly having to do with striking, is the Teamsters, with 1.3 million people, have actually announced that for the first time since 1996 they're not endorsing the Democratic candidate. And I think they're not endorsing Trump either. I think it's probably a smart move. Stay in the good grace of whoever wins the election. But the rank and file of the Teamsters is 60-40, on some polls almost 2-1 in favor of the former president over the Vice President Harris right now. But a lot of this, I think this Boeing strike is going to have repercussions, and how much we'll have to see. And let's not forget that if we get when we don't think we'll see a wage price spiral, but things like this can sort of add to it. If wages start going up, it may take some time, but the Fed will probably take notice.
And you and I, we were talking about Boeing earlier this week, and now that this has happened, we're seeing shares, at least in today's session, nearly flat on the day. But when it comes to Boeing, as they furlough tens of thousands of white-collar employees to cut costs and to avoid a credit rating downgrade during a strike by its largest union, this does present challenges. And you and I were talking about Boeing and its competition. So given the change in management that Boeing has had, there's a lot for the leader to deal with at this moment, isn't there?
Yeah, I mean, the upside is, whenever, somebody new comes in, you can probably make some moves and blame it on the sort of previous management, right? There's a famous story of a CEO to a new CEO to an old CEO, and says, or the new president to an old president, I've written 2 letters. You open this one now, and then you can open the other one later. And the one now goes, good luck. When I open the second one, when you're in trouble. And the second one says, blame the other guy or blame the old guy. So Kelly Ortberg's going to have a chance at the beginning of his tenure to make some moves, whether he wants to say, I'm going to stand fast and I really can't, we're hemorrhaging money, billions of dollars. Can I really afford to give the rank and file, a union this kind of settlement because it may not end there. So, or is he going to say, the previous management was so bad, we'll do this, let's start off afresh. But that's going to be his choice. But that is the advantage of being someone who's come in new. You have a lot of things to take care of, but you have a little more latitude for movement than you do if you've been in there a long time.
Absolutely. Well, this is one name that we will keep a close eye on, especially as we head into the upcoming week. So we have about less than 60 seconds here, and I think as we head into the end of the month, we're going to keep an eye on Washington, D.C., not just for direction in terms of what happens with the election or Congress, but also because of a potential government shutdown. So very quickly, how concerned are you right now? I'm not
I'm a little concerned. Generally, I think this close to an election, shutting down the government doesn't look good for the group that's shutting down the government, which is the Republican Party, particularly the House Republicans, which have been, as a practical matter, an ungovernable mob. Right there, it's like herding cats because they're 15 or 20 people who will say absolutely no to everything. And it's made the Speaker's job very difficult. It cost Kevin McCarthy his job. Mike Johnson came in. He's trying to shepherd something through. He may ultimately need Democratic votes to do it so as to not shut down the government, because that's something the Senate has to approve as well. So I think, given the time that we have before the election, something's going to get through before that. So I'm not too concerned.
Okay, Tai, well, as always, thank you so much for joining me, and thank you for sharing all of your insights.
Great to be here.
Thank you. And that was Tai Wong joining me, and Global Money Talk will be right back after a short break, so don't go away.